Welcome to Mortgage Markets and More. I'm your host, Peter D'Angelo. Welcome to Monday. Welcome to a fresh week where we're going to start getting into a new month here in May. Cinco de Mayo is right around the corner. I don't know about you, but I'm pretty pumped about it. We're going to get your mortgage rate update going here today, and we're going to actually start putting some more of the educational components of mortgage and real estate in separate episodes so that when I do our updates Monday and Friday, it's going to be strictly updates. You're likely going to see some shorter episodes. I just want to keep it digestible and just to the point of what's going on, what are some updates, and then I do think there's some value in still providing you with some educational ideas and topics with respect to mortgages and real estate. So those will all be released as separate episodes as we move forward. So housekeeping is done and in order. Let's talk about where these mortgage rates have gone as of recently. We always start off with our bond market review, which, to remind everyone, we look at the bond market because it is very closely tied to where mortgage rates go. And today, because something happened over the past 2 weeks, and we caught up on this a little bit last week, but the adjustable rate mortgages really took a beating in the sense of not really providing much relief from where the 30-year fixed rate mortgage is. And that is a function of how the bond market is operating. In past episodes, we just look at the 10-year treasury yield. Now we're going to look at the 10-year yield as well as the 5 and the 2, because the 5 and the 2 are where those adjustable rate mortgages normally lean on for their own quote-unquote pricing. Pricing equals what the rate is. Looking at the 10-year treasury bond, it had a bit of a volatile week last week. It was at 4.67 to end off the week, 4.67%, and that's up from 4.64% the week prior. However, during the week, it peaked at 4.73%. That caused some volatility in the 30-year mortgage rate, so averages bumped up, came down a little bit. We're going to get into that in a moment. But now here is where we're seeing those adjustable rate mortgages taking that hit. We're going to look at the 5-year treasury yield. Last week, it ended off around 4.68%. The 2-year treasury yield ended off at 4.98% after going above 5% at one point last week. The yield component here, now you got to think about it this way. We have what's called an inverted yield curve. Typically, the shorter the duration of the bond, the lower the yield. And this is in a normal, healthy, quote-unquote market. The shorter the term of the bond, you don't have your money outlaid there for very long. So normally it's supposed to give you a little less money, and the longer you invest, the more yield you should get. That's normally how it operates. Right now, it's been inverted for years. People look at an inverted yield curve, and the reason why they call it inverted is because it's supposed to go like this, 2-year, 5-year, 10-year, and up, because there's other longer maturities for those bonds. Usually goes like that, goes up. Right now, as you just heard, we're at 4.68 for the 5-year, 4.98% for the 2-year, and the 10-year, boom, down. 4.64 the week prior, last week, 4.67%. So you're making more money if you invest in a shorter term treasury bond. That is, in its essence, an inverted yield curve. The curve goes up and then down. It's inverted. Why is that important to us? We're talking about mortgages today. That inverted yield curve is normally, in the past, those were signs of recession. An inverted yield curve historically preceded recessions, save for a few times where it didn't. And that's the reason why about a year ago, and maybe a little bit more than that, you heard a lot of people saying, we're heading to a recession. We're seeing the indicators in the market. This is the one that everyone looks at, the inverted yield curve. We're not in a recession. The economy has proven to be very resilient, and if anything, a little too resilient, and that's why inflation is sticking around the way it is. We'll get to more on that later. But that's essentially why I wanted to lay out all of those pieces for you, because you will hear that a bit if you're watching the news or if you're talking to anybody in finance. That's where that's going. I'll leave it there. Let's now look at what the 30-year jumbo, 30-year FHA, 15-year, and adjustable rate mortgages look like according to Mortgage News Daily's survey of average mortgage rates in the country. The 30-year fixed rate averaged at 7.52% last week. That's up a touch from 7.44% the week prior. The 30-year FHA is sitting at around 7%, and that's up a smidge from 6.9% the week prior. The 30-year jumbo, that's at 7.68%, and that's up from 7.62%, so slightly up. We're starting to see things even out here as we're going through these. The 15-year fixed rate mortgage was averaging at 6.91%. Look back at what we talked about just now about the yield curve. If you have a shorter mortgage, it's going to look to shorter maturities in those bonds, and that's where those interest rates are correlated. That was up from 6.85% the week prior to that. And the adjustable rate mortgage, this is the standout this week, that was averaging 7.55%. We have reached the 52-week high, the one-year high, based on the past 52 weeks, the past year. The adjustable rate mortgage, that 7.6 ARM, is now the highest that it's been. And that's a function of that bond market trading, what's going on with inflation. And now let's talk about inflation. We got on Friday the personal consumption expenditure. As we've talked about in past episodes, this is the Federal Reserve's preferred inflation gauge. There's also the Consumer Price Index, CPI. We're looking at personal consumption expenditure, PCE. Next week, the Fed will be making their announcement May 1st on Wednesday. And so they're in their blackout period right now. They're deliberating and discussing their monetary policy. Expectations are that they're not going to do anything to interest rates. What's going to be most valuable from Wednesday is what Fed Chair Jerome Powell states about the outlook moving forward. If you recall, earlier this year, there was a lot of hype and expectation of a lot of rate cuts, and that has been kicked down the road, dwindled down. Now we're at the point where maybe we'll see a cut this year. And come Wednesday, we're going to have a better idea of what the Fed's thinking is when it comes to their monetary policy, and that is going to inform where mortgage rates go. What is the Fed looking at, and what do they have to consider now when they're leading up to their announcement on May 1st? They're looking at the personal consumption expenditure, and that saw the following. The headline, this is inclusive of everything. The data is not manipulated. This is just as everything's being reported. We are up 2.7% year over year, and that's over what was expected, which was 2.6% year over year. 0.1%. This is flat, this is rounding really, because you've got to also understand that these numbers also get derived sometimes 3 decimal places out. So when you're at 0.1% difference, that could be a rounding factor. Overall, this is flat. That's not good news because we need to see this going down, which it has not done yet in 2024. That's really important. We aren't seeing inflation cool further than it did as we ended off 2023. And if that continues to persist, we're going to have a higher interest rate environment that's going to persist. Now, month over month is a little bit different. That was at 0.3% month over month, perfectly at expectation. The expectation was 0.3% growth from March to April. The core is where they pull out the volatile elements that are included in the headline. So things like food and energy, they get pulled out, and that's what gives us our core reading. The Federal Reserve does look at the core with with increased interest too, because it is giving you a better indication in most respects because we've taken out the volatile elements. That is up 2.8% year over year, and that's over expectation, which was at 2.6% year over year. So 0.2%, we're a little bit outside of rounding now on that one. So we're 0.2% hotter on the core end of things. Month over month, exactly at expectation, 0.3%. I know you're probably wondering, hang on a second. Month over month's at expectation, but the year over year, how does that work? If you're expecting 0.3 month over month, how is your expectation year over year different? Great question. It is what it is. This is what the financial analysts and people far smarter than me and who do more in the stock market and analyzing the economy, this is how they looked at it. This is what I have to deliver today as far as the personal consumption expenditure. What I will also highlight based on this is that part of the personal consumption expenditure is a review of personal income. So personal income month over month grew by 0.5%. So that is the highest in recent months, going back to November now. So we're seeing that the average American is making more money. That's a good thing. However, they are spending it, and that's a bad thing. Because the more they're spending the increased income that they're receiving, obviously it's outpacing what the inflation reading is giving us, right? If we've got 0.3% growth month over month and they're making 0.5% more income month over month, they're spending more of it. That's why the year over year number is looking so elevated. That's it for me today. That's our update for mortgage rates, what's going on with inflation. I'm going to be looking forward to probably doing a special episode, or I may pivot Friday's episode to just go into detail about what happened with the Federal Reserve's announcement on Wednesday, May 1st, as well as some commentary on what that will likely be doing between meetings, because the Fed will not be meeting again for another month. So we're going to just identify some things that we could possibly expect. If you are enjoying the show, I encourage you to like, share, subscribe, share it out to your network, and I look forward to catching up with you all on Friday again. Between now and then, please make it a great week and take good care.